Hello everyone. The following video was put together a few years ago now. The graphics are a bit vintage, but the content is relatively timeless. I hope you'll find value in it, and thanks for watching. Welcome to the Value in Understanding Your Accounting presentation. As mentioned in previous presentations, accounting is the art of representing the activity of your business in a financial format through financial transactions, ultimately for decision support. If you struggle with understanding the statements, 1, you're not alone. 2, it's understandable if you're not an accountant or never had any training. And 3, hopefully this presentation will help. This financial area is only a part of the bigger picture or overall business model, but an important part, and lack of understanding is not a positive attribute in the future picture of success. We'll discuss this model more in a forthcoming chapter. In this presentation, we look at the 3 general financial statements: the balance sheet, income statement, and cash flow statement. The pieces that make up this picture: the chart of accounts and the T account. We discuss single entry versus double entry methods of accounting, cash versus accrual basis, balance sheet account analysis, how to tell if your statements are correct, one of the most important sections, and finally, understanding depreciation and prepaids. Now, let's get started. Those who don't work with debits, credits, and financial statements on a daily basis, or never had any training or guidance, understandably may be challenged in this area. If you're serious about success, at a minimum, you need to understand the basics. One of the best analogies I've heard is to think about an apple tree as your business. The tree or trunk represents the producing asset on your balance sheet. Think of the growing season as you think of the income statement. The season has a clear starting point and ending point. The income statement is like an annual scorecard. It gets reset to 0 or washed clean at the beginning of each growing season or end of the cycle. The harvest or apples represent the income, although they need to be sold or exchanged for cash. The costs or expenses of fertilizing, pruning, watering, harvesting, and selling are listed as expenses for the year. The bottom line number at the end of the cycle becomes part of the equity section on the balance sheet, as the income statement accounts are closed out for the season, like another ring on the trunk of the tree. The third statement is your cash flow statement. As the cycle occurs over the period, the cash flow statement simply tracks and organizes to explain the change in cash or movement into 3 main categories: cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. It's a reconciling of the change in cash, represented on the balance sheet with a prior year comparison, from the beginning of the period to the end of the period, resulting in the net change in cash. Cash from operating activities is the cash in from selling the apples, and the cash out is from the cost of pruning, fertilizing, harvesting, and selling the apples. Cash from investing activities would be the cash in or out for selling or purchasing more trees or harvesting equipment, generally found in the assets section on the balance sheet. Cash from financing activities would be cash in or out from loans, purchase or sale of stock, or other capital flows from owners, generally found in the liability or equity section on the balance sheet. The balance sheet is a snapshot in time, and sometimes called the net worth statement. The income statement, or P&L, profit and loss, is the scorecard for the cycle or season. These statements consist of different types of accounts, which make up the chart of accounts. The cash flow statement focuses on the change in cash and doesn't have any accounts specific to this statement. It tracks the change in all of the accounts found on the balance sheet and the income statement from the beginning of the period to the end of the period or cycle. Understanding these different accounts is where many get confused. We suggest to simply memorize the basic types or take a mental snapshot of our visuals. For instance, the balance sheet is made up of assets, liabilities, and equity accounts, with a simple formula where assets equal liabilities plus owner's equity. Assets are defined as things the business owns, such as cash or checking accounts, inventory, accounts receivable, equipment, etc. And in our example, the apple tree. These accounts are generally grouped as current assets, fixed assets, or other assets. Liabilities are accounts that record the debt the business owes, such as accounts payable, loans payable, payroll taxes, credit card accounts, etc. These are categorized or grouped as current liabilities, debt due to be paid within a year, and long-term liabilities, debt due to be paid in a time frame greater than a year. Equity account names vary by entity type, and together represent the cost basis net worth. A corporation would have a capital or common stock account, which is the amount the shareholder paid to the corporation for their shares of stock, generally a par value amount. There may be a paid-in capital or surplus account, from amounts paid in excess of the par value of the capital or common stock, and a retained earnings account, which represents the corporate income over time that has not yet been distributed to the shareholders. If this corporate income, also called earnings and profits, are distributed to the shareholders, it's a taxable dividend to the shareholder. If the corporation is an S corporation, there could be an accumulated adjustment account. S corporation dividends or distributions are generally not taxable because the net income is taxed or passed through to the shareholder each year. There could be a treasury stock account, which represents stock that was bought back from the shareholder. In a partnership, each partner would have their own capital account, reflecting the partner's share of contributions, withdrawals, taxable and non-taxable income and expenses. A sole proprietor may have only one capital account or may choose to create another called a drawing account to track any withdrawals taken by the owner for tracking purposes. This would be similar to a corporate dividend payment account to keep the transactions separate. The income statement reflects revenue or sales accounts, defined as income one receives from normal business activities from the sale of goods and services to customers. Cost of goods sold are defined as the direct costs attributable to the production or sale of goods or services. The revenue less the cost of goods sold net to a gross profit figure or amount. From there, the expense accounts are deducted and defined as expenditures or costs that do not acquire, improve, or prolong the life of an asset. Examples are telephone costs, utilities, insurance, payroll, office supplies, cleaning, rent, etc. Some categorize these expenses into groups called marketing and sales, or operating, or general administrative expenses. Finally, getting down to a net income figure, which then transfers to the equity section on the balance sheet at the end of the period as the income statement accounts are closed out or reset to zero for the new period or cycle. Most of the discussion in our presentations are based on the double entry method of accounting, and before we highlight the single entry method in the next section, our discussion here wouldn't be complete without a brief look at the T account, what this whole double entry system is based upon. This is where the term debits equal credits come from, and every transaction has at least two accounts affected, and debits always equal credits. We suggest not to try to make sense of this debit-credit thing, but only to visually see the two sides, that debits are on the left and credits are on the right side of the T account. A memory trick is to think of the DC two-step, or maybe Washington, D.C., as a reminder that debits are first, then credits. Looking at the balance sheet as a T account may help. Assets have a debit balance while liabilities and equity accounts have a credit balance. And on the income statement side, the revenue accounts have a credit balance while the expenses have a debit balance, with the bottom line net income representing the net difference of debits and credits, also showing in the equity section, keeping the debits equal to credits. And if you're not thoroughly confused yet, there's another point that needs to be made regarding the cash accounts. Most of us are familiar with banking terminology or a bank statement, where a credit to the bank account increases the balance and a debit to the account decreases the account balance. Unfortunately, Double entry accounting is just the opposite. A debit to cash increases the account because cash is an asset and assets have a debit balance, the left side of the T account, and a credit to cash decreases the balance. When a check is written, let's say for utilities, utilities are debited, the expense is increased, and the checking account is credited, reducing the balance in the checking account, reducing the debit balance. When a deposit is made from a sale, cash is debited and sales are credited, increasing the debit balance in the cash account and increasing the credit balance in the sales accounts. When a credit card charge is entered, let's say for office supplies, the office supplies account is debited and the credit card liability account is credited, which increases the debit balance or office supplies expense account and increases the credit card liability or credit balance. With processes like those done with QuickBooks, such as creating an invoice, receiving a payment and making the deposit, paying a bill or a credit card, etc., you don't need to understand the debits and credits, but that in every process behind the scenes, the system is debiting and crediting those affected accounts. When considering the single entry versus double entry form or method of accounting, the single entry method is generally used with the small micro enterprise, sole proprietor, or single member LLC that uses the Schedule C tax form included with the personal 1040 tax return. The focus here is on income and expenses with a calculation for depreciation expense. The source documents are added up and categorized, generally using a green bar column paper or electronic spreadsheet, summarized for the tax return. This system becomes more inefficient and error-prone as the number of transactions increase and become more complex, or when a balance sheet is required. The single entry form is not our recommended form because it lacks a control system to catch or find mistakes or missed expenses, causing incorrect tax calculations and potentially overpayment in taxes. The IRS doesn't require any specific method of accounting as long as the one used is accurate and complete. Certain tax returns require a balance sheet, such as corporations and partnerships. These entities should use the double entry form based on the T account. The double entry system, when used with software such as QuickBooks, creates efficiency, lowers errors, and helps with decision support. When we compare cash versus accrual, cash is the simplest and used most by small businesses. If the production, purchase, or sale of inventory is a substantial income-producing factor, the accrual method should be used. And there are hybrid methods, which is a combination of the two. And generally, a service-based business can use the cash method, but there are a number of rules and exceptions for tax purposes. This area can get complicated and should be resolved or worked out with your tax advisor. For this section, we have included portions of our cash versus accrual clip with QuickBooks. If you do just a little research regarding the cash versus accrual form of accounting, it may become clear that one isn't better than the other. There are pros and cons to both, and there are rules to which method you can use for tax purposes, depending on your situation. With QuickBooks, it doesn't matter. With a click of the mouse, you can see your situation both ways. Cash basis is recognizing income and expense based on when you actually receive or pay the cash. Accrual basis is a matching of income with expenses in the same period, not tied to when you actually receive or pay the cash. In essence, the difference is simply timing. For this presentation, we have pulled up two balance sheets and two income statements, with one set as accrual basis and the other cash basis. In this example, we have a new company with no activity except for the initial equity deposit of $10,000 in the checking account. And since QuickBooks operates as a double entry accounting system, every transaction has at least two accounts affected. In this case, the checking increased and the equity increased. So let's add a couple transactions and compare. Starting with an invoice for services rendered on December 1st for $1,000. Noting that we have set the preferences to refresh the reports automatically. Notice only the accrual statements are affected. Accounts receivable has increased and the income has increased. Again, the double entry system affects at least 2 accounts. We have created the invoice but not yet received the payment. Therefore, no effect or change to cash. Now, let's create a bill for December's rent for the company's office of $400 due on December 1st. Noting that we didn't pay the rent but only listed it as a bill in accounts payable. Again, the accrual statements are affected with no change or effect on cash. On your first tax return, you'll have to establish your accounting basis for tax purposes. In this situation, if you are accrual-based, you will have to pay a tax on the $600 of net income that you have not yet received, because in this example the city pays 30 days later and the payment was received in January, the next calendar year, noting that the check or cash for rent was also not paid by the end of the year. A side note and little memory trick to help remember the difference of accrual and cash basis is the A in accrual has the A in accounts receivable and the A in accounts payable. Or more simply, accrual has accounts payable and accounts receivable, where cash basis is all about the cash. Cash didn't change, the income didn't change, and cash basis for your tax return would show a 0 net income or taxable income. Again, accrual basis is a matching of income with expenses in the same period, not tied to when you actually receive or pay the cash. The income earned for services to the city in December and the expense of December's rent for the company's office. Now let's change it up. Let's say the city paid the invoice before their 30 days. We update the system for the payment on December 31st, noting this is within the accounting period. And now the reports are updated for the receipt of funds from the city's invoice. Cash has increased in both the accrual and cash basis, but only the cash basis income statement is affected by the $1,000. The 2 accounts affected in the accrual statements are the checking account increased and accounts receivable decreased by the $1,000. The total assets stayed the same. The receivable was simply turned into cash. Receiving the cash had no effect on the income statement. With the cash basis statements, the checking account also increases along with the revenue and income statement. The same effect happens when you pay the rent bill, if it's paid within the period, in this case before the end of the year, because our income statement period is for January through December, and December ends the tax period. Noting the cash basis statements now reflect the rent check or cash transaction. Now, the accrual and cash basis income statements match up because the cash moved in the same period as the matching of the income and expenses. At the beginning of this section, we said there are pros and cons to both methods of accounting, which helps make QuickBooks valuable. You can look at your books both ways, managing by the accrual system, keeping an eye on accounts receivable, accounts payable, and the cash situation. Ultimately, understanding your tax position and having information ready for tax preparation. This presentation was laid out to give you an overview of the flow of data and how it may affect your tax situation, and the ability of a software program like QuickBooks to help manage the differences of the cash versus accrual methods of accounting. On several occasions throughout these videos, we've discussed the value of making sure your accounting information is correct. But how do you really know? A big factor is understanding the difference between the balance sheet and income statement accounts and their effect. Easy to do incorrect postings to an income statement account when it should have been a balance sheet account or vice versa can throw the books off dramatically. If one is unsure of which account to use, we suggest to set up a suspense account. You may want to watch our suspense account video clip in the Running with QuickBooks videos for more information. In this section, we'll illustrate by example. As we look at the balance sheet and income statement with prior year comparisons, we can see the balances are zero because the business was started during the current year. We did this in this example so we knew our beginning balances on the balance sheet were correct, which is important, and it should be noted the beginning balances should always match the end of the previous finalized year. You may want to watch our Closing the Books / Lockdown Mode video clip, one of the Running with QuickBooks videos. In this example, the company received a loan from the bank for $25,000. Because the bookkeeper wasn't sure how to handle the transaction and always posted the daily deposits to sales, that was the account it was posted to. After the deposit cleared, the owner bought a tractor for $18,000. The bookkeeper received the paperwork and entered the cash disbursements check into the system. Again, not sure which account to post to because it was out of the ordinary daily transactions. Scanning through the chart of accounts, the tools expense account was chosen. Several weeks later, a bill from the bank is received requesting a payment on the loan. The total bill was $3,500. $2,000 for principal and $1,500 for interest. As the check was written, the whole amount was posted to interest expense on the income statement. Without understanding how these transactions affect the statements, these errors can easily happen because the bank balance is correct, which at this point is the main concern of the business owner. At year end, the statements are printed off for the tax preparation. Unfortunately, the books are incorrect. Now the tax return is incorrect, and more taxes were paid than legally should have been. Now, let's change the perspective. If the bookkeeper would have posted those 3 transactions to a suspense account, listed as a current asset, the tax accountant at year-end could simply pull up the transactions and reclass to their proper accounts based on supporting source documents or notes in the memo field. The key here is to verify the ending balances on the balance sheet for the period. This is done through a reconciling process for each account, virtually the same process as doing a bank reconciliation, which is the bringing together 2 sets of accounting and resolving the differences. This can be done with virtually every account. The cash accounts receive the bank statements to be reconciled. The credit card accounts receive their monthly statement to reconcile. The loan accounts can get year-end transactional statements to reconcile the principal balance and the interest expense for the year. The fixed assets and accumulated depreciation can be reconciled or tied to the books, including the depreciation expense from the depreciation schedule. Now, if we know the beginning balances are correct and the ending balances are correct, the only variable left is the year-to-date income, which is the summary of the income statement transactions. If proper controls and procedures are in place for correct processing of income statement transactions, you can have a high level of confidence your books or statements are in good order and clearly representing your business activity in financial form. Trying to understand prepaids and depreciation is a bit easier with understanding the difference between the balance sheet and income statement. Knowing the balance sheet holds the asset or value while the income statement is a recurring scorecard of the profitability of the business activities helps. To illustrate, let's use insurance as an example. Let's say we get the best deal if we make one upfront payment for a year of insurance in the amount of $1,200, payable in December for the forthcoming year. If the $1,200 is posted on the balance sheet as a current asset account called prepaid insurance, having no effect on the P&L, cash was simply exchanged for a year's worth of insurance. It's like the balance sheet or the account is holding a pot of insurance, which is to be dipped out as it's being used over the next 12 months. The adjusting journal entry, in essence, is the dipper, taking monthly amounts from the pot, the prepaid account, by crediting or reducing the prepaid account and debiting or increasing the insurance expense on the income statement each month as it's being used, more clearly representing the economic substance or transfer of value over the time period. Note, these statements are for the year with a prior year comparison. If we look at next month's statements, January of 2012, with the prior month's comparison of December 2011, we can see the prepaid account was reduced, while the profit and loss is showing the expense. The supplemental use of an Excel spreadsheet helps track the correctness of the transactions, giving the ability to quickly look at past amounts as the history is added, using this as part of the reconciliation process, as mentioned in the earlier section. This helps to visually analyze the flowing amounts. In essence, depreciation works the same way, just the form is a little different. If we consider the $18,000 tractor purchase from the prior section, the only difference between this fixed or depreciable asset and the prepaid account is the cost stays fixed in the asset account as long as it's owned by the company. In this example, the tractor's estimated value will be used up or depreciated over 10 years. The cost of $18,000 divided by the estimated useful life of 10 years equals $1,800 of depreciation expense per year, or $150 per month. Again, the adjusting journal entry is the tool to transfer the amounts on the books, which debits or increases the depreciation expense on the income statement and credits, also increasing the accumulated depreciation account on the balance sheet. The prepaid account is filled with the initial payment and slowly gets reduced over time as it's used. The accumulated depreciation account, or bucket, starts initially empty as the value of the fixed asset is used or expensed based on the computation. The amount in the accumulated depreciation account, or bucket, begins to increase. This account is known as a contra account, offsetting the original value, netting the two accounts, shown here by the negative in front of the $150, 1/12 of the yearly depreciation expense of $1,800, which gives a net book value of the asset. It should be noted there are different depreciation methods and recovery periods based on the different types of assets for both book and tax purposes. These details are beyond the scope of this presentation and should be left for the CPA or accountant to resolve. At the end of the 10 years, the balance sheet, as of 12/31/2022, still shows the $18,000 in the fixed asset account and $18,000 in the accumulated depreciation account, the yearly depreciation expense added up over the 10 years, making the book value equal to 0. In the real world, the tractor may still have a residual value or a fair market value, even though the book value is 0. If the tractor was sold at the end of 10 years, let's say for $2,000, the transaction on the books looks something like this. The cash of $2,000 is deposited, increasing the balance in the account, shown on the journal entry as a debit. We know the tractor was sold and should now come off the books, shown here as a credit on the journal entry because it reduces the fixed asset balance sheet account. Any accumulated depreciation associated with this asset up to the time the asset was sold also has to come off the books from the sale, along with the asset. In this case, the tractor was sold 10 years after it was purchased and was fully depreciated from the 10 years of depreciation expense at $1,800 per year. As mentioned in the prior section, debits always equal credits in every transaction, so in this situation, $2,000 is left to balance the transaction and should be posted to an income statement account called gain on sale of asset. To summarize, the cash is increased by the $2,000 received for the tractor, the asset and the correlating accumulated depreciation is taken off the books, and the gain shows on the income statement. It should be noted it's generally more efficient to simply post the transaction to a suspense account with a note when the deposit is made, leaving the details of the accumulated depreciation for the CPA or accountant to resolve. Generally, it takes more time, therefore more costs, to unravel an incorrect journal entry than it is for the accountant to do it correctly the first time.